Okay, as I start the moving average section, I just want you to understand as well that in a free DVD like this, 60 minute, we cover many things that sometimes require 60 minutes only just for this, like one topic. So it's really a peek at, what you would learn and what we look for, but there's more time to be invested into this, so you can become a good trader. You won't do it in 1 hour, that's for sure. If you think about, making a lot of money trading and doing it in 1 hour, I think it's definitely not realistic. I've not seen many people do it. I actually never saw anybody that, or never met anybody that became a good trader, not putting the time and, making the sacrifice to be able to learn it. But as I said, and I said that many times, it's worth it because as soon as you get that type of control, things change. You can basically get money in the market every day and almost every day if you don't. But you have a very good consistent trading pattern. So moving averages. You can see, let's use a 20 period moving average. What it is, basically, if you don't know much about moving average, it's just a calculation that taken the last 20 days, divided by the price, and that gives you an average. And that it's a simple moving average that I use as well. That basically give you a point, and then there's a line being traced right here, the blue one, if we take the 20. Okay, the gray here is 10, and then we have the 50, and then we have the 200. When you have a stock that trend over all the moving average, that means this stock is very, very, very strong. But let's look at this. Every time a stock comes and kiss the 20 moving average, let's say kissing, in the sense that it gets close to it, you see the stock rebound and being pushed back up. Okay, and you can see here, that's every time it's a key location point where you can buy the stock with confidence, and then you reposition yourself and you do the same thing right here. So that's one of the elements that we add on top of all the other one, that we basically use as a guideline to say, okay, you know what, that's the right time to enter or the right place to enter. Okay, just want to make sure I have the right one, the right slide. Okay. So you see Celgene, you have the same situation right here. Everything, the stock was actually coming from lower prices right here, and then it's been building a bottom or stabilizing, if you want, in a range from around 44 to 38. But as you see right here, you get, a lower, basically, you could say a bottom or a support that help the stock, and then as it come back, the market, or actually the market maker or traders or investors in the stock didn't let the stock go lower than this price. And you know what? It just happened that it's a 20 MA. So now your low is at higher level than this low, and you've got a 20 MA that is rising. So you have a move, and getting in at basically at the start of something that could be much bigger. So the moving average we use, I mentioned them a bit earlier, the 10 moving average, the 10 period moving average, 20, 50, and 200 MA. Just on that, we can spend a few hours talking about when we use them, how we use them, and what to look for. Like the 200 MA in some situation will totally stop a stock. You see the stock riding or going straight to the 20 MA, the 200 MA, and you will see the stock stop dead in its track, and there's a reason for it as well, but we won't get in detail here. So I just wanted to show you that the moving average is used, on the bullish side or the bearish side, going up or down, doesn't matter. And when we short, it's there's a small nuance. Sometimes the stock there's a lot of they call that short rallies. Okay, most of the short rallies will go as high as the 50 moving average, and this is a good example. The stock right here just stays under the blue line. Okay, you can see it looks like it wants to go down, and right here you've got a gap up right at the 50 moving average, the 50-day moving average. and from there it just fall like a rock. We don't need to know, all the, because you could say, oh yeah, all the news were, coming out about the, bank getting in trouble and insurance company having problem. You really don't need to know it, to know all the news. You just need to look at the chart, because after that there's information that you don't know, but who knows who was selling right here. Definitely some people that knew they had to get out because they didn't care. They were just pushing the stock down. And that's one thing that technical analysis will help you with. Then PCX is another example of a stock rising and basically getting stopped at this point by its 20 moving average. Okay. And then from there, it's being supported, and at this point the stock is so strong that it doesn't even go back to the 20 moving average. It gets supported by its 10 moving average. I really use an 8, but most people use 10, but I use an 8 moving average. But I'm just so you know, if you try to run the calculation on this one, it's an 8 moving average, 8 period moving average.